We've taken a look at some of the GATT rules and U.S. policies concerning free trade agreements, but I want to take a look now at the economic analysis of preferential trade agreements. So we're going to be looking at an FTA per se rather than a customs union. We're going to be doing this in the context of a partial equilibrium analysis. Recall that that means that we're going to analyze one particular product at a time. In this case, when Brazil will liberalize in one sector, we'll talk about multi-sector liberal analysis at the end. The basic question that we're trying to ask is the following. Does a partial movement towards full trade liberalization necessarily benefit a country? For people that think that trade liberalization is a good idea, the common intuition is that if you want to get in the direction of free trade, a half step towards that, a partial movement towards overall free trade should be a good thing. And that's what many people will argue. It turns out that the economic analysis is not quite so simple, that a partial movement can actually make a country worse off. And in this context, we're going to be introducing two concepts, trade creation, which is the upside of the free trade agreement, and trade diversion, which is going to be the downside. So we're going to do this in the context of a three-country model where Brazil is going to be the importing country, and it's considering whether or not to have a free trade agreement, eliminate tariffs on either Japan or on Argentina. And we'll do this in the context of Japan being the cheaper source of this product in the international market. So PJ, the price in Japan, is less than the price of Argentina, PA. So this is all done within the Brazilian market, and we're going to assume initially that Brazil has MFN tariffs, the same tariff level on both the Japanese and the Argentinian sources. So the free trade imports would come from Japan. There would be Q6 demanded inside of Brazil and Q1 supplied by Brazilian companies, and you would have a free trade imports of Q6 minus Q1. But we're starting with tariffs on both countries. When you have MFN tariffs, the same tariff on both the Japanese and the Argentinians, the Japanese product is going to be the relevant import source because the Argentinian price plus the tariff exceeds the Japanese price, and the Brazilians will import from Japan. Japanese importers would have to pay the tariff, and the amount that would be imported would be Q4 minus Q3. That's the demand at the tariff distorted price minus the supply in Brazil at the tariff distorted price. So the initial circumstance, and we're going to not even bother to include the tariff distorted Argentinian price because it's irrelevant. They're priced out of the market. The original distortions with tariffs on both countries is the standard deadweight losses of RJK and UMN. So if you recall, RJK is the production inefficiency associated with the tariffs. UMN is the consumption inefficiency, the consumers that are priced out of the market because there are tariffs on both sources. Let's first imagine that we have a free trade agreement with Japan. What we'll see here is that the relevant price is now PJ. So you've maintained the tariff on the Argentinians. You've only removed it on the Japanese. And so what you're going to get is an increase in consumer surplus equal to the difference in the prices over to the demand curve. It's that entire area, VRSU, WJKLMN, so it's a lot of letters, but it's really just the standard analysis. Brazilian producers will gain VW. That's the area defined by the change in the price over the supply curve. So again, standard producer surplus gain. And the government is not going to be earning any tariff revenue. SL is the amount that they used to earn, the government used to earn on imports from the Japanese firms. That no longer is collected. So again, the efficiency gains are really exactly the same as if you had MFN liberalization. It's those two deadweight losses identified on the previous slide. So a free trade agreement with the low-cost supplier is actually quite similar to, and even identical to, having MFN tariff liberalization. So the FTA with the low-cost supplier is indeed a good policy. So let's imagine that instead you have a free trade agreement with Argentina. So we're going to retain the tariff on the Japanese. So the price that the Japanese can sell inside this market is PJ plus T, but the Argentinians can sell at PA. So the Argentinians can now sell inside the Brazilian markets, undercut the Japanese, and gain access to this market. So from a Brazilian consumer standpoint, they get lower prices. The price falls from PJ plus T down to PA. There are benefits. And so what we have is that the benefits to Brazilian consumers is the area defined by the difference in the price over to the demand curve, VRSU. That's a good thing. And that is a part of the consumer surplus that could have been gained by overall liberalization. So if you look back at the previous slides, you can see that. So this is a partial gaining of the benefits from free trade. Brazilian producers only gained V. Price didn't fall as much as under broad free trade or an FTA with Japan, but there are producer losses. Now the question is, what happens to government revenue? Now, if you have free trade with the Argentinians and you import only from the Argentinians, then the government is going to lose all of its tariff revenue in this market. Sure, there are tariffs on the books, tariff rates that are listed for the Japanese imports, but if you import from the Argentinians and don't import from the Japanese, the government gains no tariff revenue. So the government tariff losses are S plus L. So they don't gain any revenue. If you look at the net effects, canceling out the gains and losses, i.e. a transfer domestically doesn't affect the economic welfare, what you have is that there are net gains of RU and losses of L. Now these are indeed, so I should say that whether or not this is a net gain or a net loss depends on the relative sizes of RU and L. And these are the trade creation and trade diversion effects. RU is the benefits from liberalizing trade. Domestic production has gone down from Q3 to Q2, so you gain back some of those production inefficiency losses that you'd had before. So R is the production efficiency gain, and U is the consumers that are the consumer surplus associated with consumers who can now buy this product who couldn't before. So R and U are the trade creation effects. These are the benefits associated with lowering prices to the Brazilian economy. L is going to be the trade diversion effects. So let's look at this in a bit more detail. So RNU, as I mentioned, are these standard efficiency gains associated with expansion of trade. And let's take a look at L in a little bit more detail. So Q3 to Q4 used to be imported from the Japanese before the policy change. And A, that green box, was how much the Brazilians had to pay the Japanese at the border for importing Q4 to Q3. Now, there was a tariff on top of that, but A is what the Japanese earned and what the Brazilians had to pay at the border for importing Q4 to Q3 from the Japanese. After the free trade agreement with Argentina, to get that same amount of goods, the Brazilians have to pay L plus A to the Argentinians at the border. So you have an increased cost to importing this product from the Argentinians rather than the Japanese. And L is that increased cost. That's the trade diversion effect. So if the trade diversion effect is relatively small, that there's not that much difference between the Argentinians and the Japanese, this can be a good policy. To the extent that you have a free trade agreement with a high-cost supplier, then it's more likely that these trade diversion effects will outweigh the benefits from the lower prices. Now, when people look at a free trade agreement, they may often look at just the trade creation effects, that we've got this lowered cost to the domestic economy from importing the product, but there's this opportunity cost associated with importing from potentially the wrong supplier. Now, in practice, in order to analyze whether or not a trade diversion, trade creation outweigh the other as a whole for an economy, you need to look at not just one market, but you need to look at a bunch of products from many countries. Now, this is not something you can do in a simple supply and demand graph, but governments will use what are called computable general equilibrium analysis, which I don't have time to talk about here, but where you do indeed try to look at the simultaneous effects of all these different potential markets where you may be having a free trade agreement with a low-cost supplier in some goods, a higher-cost supplier for other goods. It really just depends. So summarizing this story, a particular agreement with a particular partner may or may not be a good plan for a country's economic welfare. It does have the upside of lowering the price. You get some trade liberalization, and there is an associated trade creation effect, which is positive for the country that is liberalizing. But there is a potential downside. There are trade diversion effects associated with picking the wrong partner, essentially, where you artificially give access to one country's exports, which may be a higher cost than the alternative source. This is an example of what's called a second best solution. The first best, the ideal, might be to liberalize trade with everybody, but when you remove one distortion, that is to say, the imports for a particular country, while retaining a distortion on another country, it may or may not be beneficial. It just depends on the details of particular markets.